mortgage rates versus APR, or annual percentage rate. We're going to break down the significance of these two numbers, how they're calculated, how you go from one to the other, and why it was developed or devised by the government, the APR was. So we're going to go with the example. Please stay until the end. We're going to talk a little bit more, explaining how it kind of all comes together. So again, rate versus APR. And I just put it down here that APR stands for annual percentage rate. So let's just say our rate, okay, is 6%. And our loan amount is going to be, mortgage amount is going to be $300,000, and it's 30 years. So the resulting payment, and I'm going to round it up a little bit, but resulting payment will be $1,800 per month. So that is just a regular rate. If someone says, okay, this will be your rate when you start receiving your mortgage statements, that will actually be the rate, 6%. Now, what is the APR? This is how government wants us to calculate the APR. Suppose that the closing cost, so now this is the rate calculation, and this here we will have the APR calculation. Suppose the closing costs were $10,000. So the government says, well, you know what? In fact, you didn't finance, or you didn't get 300,000. You got the difference. You really got 290,000. It's this A minus this B. So this is C, which was equivalent A minus B equals 290,000. So now what they want to do, they want to use this $800 and determine the rate. If the payment is $1,800 and the loan amount is now in fact $290, because that's what would be the effective rate. My payment stays at $1,800 because that will be the payment what the person will be paying. The real financing, according to the government, is $290. If I plug these numbers into the calculator, my APR, the effective APR, becomes 6.31%. So that's what you're going to see on some of the disclosures. The APR of 6.31, but the rate will be 6. Now, I will mention again that you are paying the rate of 6% every day, but because of the closing cost, the effective one is this, and that measures how much really the closing cost is involved. If this number goes up, let's say it becomes 20,000, the APR will go up. If your closing cost is less than 10,000, the APR is going to be less than that. So we just showed you how you calculate and what is the APR. The important thing to know is APR was really devised so people can compare their true borrowing costs. In other words, without that APR, without the closing cost, the APR would always be equivalent to the rate. Hopefully it answers some of your questions, and now you know at least a little bit about what it is. But if you have more questions, as always, please write us in the comment, like this video, follow us, and we will see you soon.